I'm going to talk about stocks and the different kinds of stocks and the laws of the stock market here today. And then I'm going to come at the end with a couple of examples of companies. I have an example of Xerox and Microsoft, both high-flying companies in their days. Another term that I just want to use, corporation. Corporation comes from the Latin corpus, meaning body. And the idea of a corporation is like a legal person. The lawyers say natural person. Each one of you is a natural person. But there are artificial persons as well. And the corporation is called an artificial person, even though it really only is it's owned by people. It's like a slave belonging to the shareholders. So that's the origin of the term. Actually, corporations go back to ancient Rome, where they were called publicani. And they had a stock market in the Roman Forum, but they were never allowed to proliferate. The laws encouraging them did not create a swell of new companies. There were very, very few of them. It wasn't until the 19th century that corporations really became important. Now, a corporation is owned by the shareholders, okay? And in most corporations, all the shareholders are equal. That's why we call it equity. And they all have one vote. It's one share, one vote. Not always. There have been exceptions. There are non-voting shares. But usually, they all vote. And the idea is that the shareholders vote to elect a board of directors. This is what they call shareholder democracy. It's inspired by political democracy. So we're going to set up a company that's democratic. But it's not democratic in that every person has a right to vote. It's each share has a right to vote. And so that's the essential idea. The board of directors, by tradition, it's when you form a company in the United States, you have to choose a state to incorporate in, okay? And then each state has its own corporate laws. So my company, we did it in Massachusetts. A lot of people like to do it in Delaware because they like those laws of Delaware and the taxes of that state. So you choose, and then the state will dictate some basic rules, typically that you have to have an annual shareholders meeting where you vote. That's the idea. And we did that. I remember we followed the law. It was a great, someone had a plan and it worked. And so what do you do at the shareholders meeting? Well, anything according to the bylaws of the company, certain things have to be decided there, but not many. The basic thing you do is you hire a chief executive officer. You agree to hire that person. And then the chief executive officer reports to the board as an employee of the company. Okay. And in the U.S., the chief executive officer has, by tradition, often been named as chairman of the board. But in Europe, that's less likely. There's some different traditions. And in the rest of the world, a lot of people say it's not good to have the CEO as chairman of the board. All right, the value of a share in the company is equal to the total value of the company divided by the number of shares. Okay, so the market cap of a company is equal to the value per share times the number of shares. Market cap is short for market capitalization, and that is the value of the company. The the key thing you have to know about a company is how many shares are there and how many shares do I have. All right, maybe I'm repeating myself, but if there's a million shares outstanding and I own 1,000 shares, then I own 1/1000th of everything the company owns, because I own after their debts. And so, but if there's 10 million shares and I own 1,000 shares, then I own only 1/10,000th. So you have to know the number of shares. The number of shares that you own is meaningless unless you know the total number of shares in the company. And all the different shares are treated equally. If they pay out any money to one shareholder, they've got to pay it out to all the other shareholders in proportion to the number of shares. Now, companies issue dividends. A dividend is paid to shareholders when the board of directors decides to do it. And the board of directors doesn't have to do it. I'm talking now exclusively about for-profit, all right? So at a board meeting, they can say, hey, let's pay a dividend. I remember this because we had exactly this meeting in our little company. We gave shares to all of our employees to motivate them, right? Everyone's a shareholder, but they had tiny numbers. Some of them had very little shares. And we had a board meeting, and we said, you know, we've never paid a dividend. Should we do it? Should we pay a dividend? And then we had a discussion, and someone said, well, you know, all these employees wonder if their shares are worth anything. So maybe if they got a check in the mail, they'd feel better. But you see, the dividend is subject to the discretion of the company. Ultimately, people own shares to get dividends, right? Because they need, the dividends is the distribution of profits. If a company never distributed dividends, it would be like a nonprofit, right? If they kept all the profits, they can do that. There's no law saying that they have to distribute dividends. They can just keep it in the company and, like Yale University, get a huge endowment and just let it get bigger and bigger. But you know, the whole purpose of a for-profit company is to pay dividends, and so sooner or later they do it. So typically, young companies don't pay dividends. Why not? Because everybody knows that our money is in the future. We're starting up. We're not making a lot of money. In the future, we'll have a lot of money. So let's pay dividends later. For example, Microsoft, that I'm going to describe, went through decades without ever paying a dividend. They just kept plowing it back into the company. Now, if you knew that they would never pay a dividend, then you wouldn't want to own Microsoft shares, but you'd think, well, eventually they're going to. And so that's why you own the company. But this is a very common misunderstanding. A lot of people think that you buy stocks because the price will go up, okay? Well, the price will go up only because people think there are more dividends coming. At least in theory, that's the way it should be. The price ought to be, and we'll question this later, but it ought to be the present value of expected future dividends. And so the true value of a company is entirely in the dividends. It seems a little funny because you think, well, the board of directors doesn't have to pay a dividend, and they could just get nasty and never pay it out. But remember, you elect the board of directors. And so if you're frustrated that our company is accumulating lots of money and it's not paying it out, I want the money, right? So I'm not going to vote for this board. I'll put Carl Icahn on or someone else. Pay it out. And then that's what happens. They start paying it out. When they pay out a dividend, the share price falls generally, right? Very simple. Why would the share price fall when they pay out a dividend? Well, because the company is worth less. They had this money and they paid it out. So it should fall by the amount they paid out divided by the number of shares, right? And companies do that routinely. When they declare a dividend, the price falls. That's called the ex-dividend price. And they show it in newspaper. Well, they don't do it. They used to show it in newspapers. Now it would be on the website. They put a little X by the stock price on the day after a dividend is paid to tell you that the price decline that you just saw is not anything to worry about. It doesn't mean there's bad news about the company. It just means they just paid a dividend. So the price routinely goes down by the amount of the dividend. I just wanted to remind you of the term dilution. Dilution refers to what happens when a company issues more shares. So imagine that you are showing up at a shareholders meeting and someone's saying, well, the board has decided to issue, let's say our company has 1 million shares outstanding. They've decided to issue another 1 million, okay, at $10 a share. And so what do you think about that? Well, if the company had 1 million shares and I owned 1,000 shares, then I owned 1,000th of the company, right? If they issue another 1 million shares, then there will be 2 million shares, and I'll own only 1/2,000th of the company. So my first thought is, I don't like that. I owned 1,000th of the company. Now I'm falling in half. But they would say, on the other hand, look, we're selling them for $10 a share, so the company will have $10 million to invest. So even though your fraction of the company has been diluted, the company is worth more. And then you have to decide whether $10 a share is a good enough price. Is it worth that? And so it's never obvious. You always have to consider dilution, because anything that expands the number of shares decreases your interest in the company. The opposite of dilution occurs when the company buys back its shares. And so that's repurchase of shares by a company. So a company can always do that. They can decide to go either way. If they need more money, they can issue shares, and if they want to get money back, they can buy. If they want to get money out, they can buy back shares. And these things are very common. There's statistics like what Fama and Trent showed for equity issuance, would show that repurchases are very common. It happens all the time. So the market, that's what makes the stock market so active. One reason traditionally for share repurchase is tax reasons. If the company repurchases its own shares, if a company pays a dividend, that goes in as income for the shareholders, and it's taxed. It used to be taxed at a higher rate than capital gains, so there was an advantage to share repurchases. Instead of paying dividends, I should just buy back shares. And then the shareholders would have a better tax. They would be taxed at a more advantageous rate. But now the tax rate on dividends and the tax rate on capital gains is the same. But still, there's always going to be complicated tax issues. And so issues of taxation may still motivate some decisions about share repurchase. But you have to understand that it's getting money out of the company. And as a shareholder, if the company wants to send me a dividend, I say, fine, I've got money. If the company says, I want to buy some of your shares back, you say, fine, I've got money. I don't care, right? And so if they buy back 5% of all their shares, then the total number of shares goes down. My fraction of the company is the same, right? And I've got money. It's the same as getting a dividend. So you can be confused by these things. Dilution and repurchase are neither good nor bad. It depends on circumstances. And you have to look at the business and what's being done with the money. And I wanted to mention there's another kind of share called preferred. There's two. Well, I've been talking here about common stock. Common stock is the real ownership in the company. There's another thing, in other words, you take all the profits, they're the ultimate owners of the company. Nobody is above them in the hierarchy. But there's something close, it's considered close but different. It's called preferred stock. And preferred stock pays it has a set dividend. But the contract says that the dividend is so many dollars per year. And the board doesn't have to pay it. But if they they cannot, typically the contract says, they cannot pay a dividend to the common shareholders until all the dividends to the preferred shareholders are paid up. And the preferred shareholders typically don't have a vote. Okay? So this is it. So you could buy preferred stock in some company, and then you would know exactly what your dividend. Usually they just pay a dividend. It's like owning a bond. And it's always the same amount. So you're not betting on the company doing better or worse, generally. But if it does badly, you might lose your dividend for a while. If the company goes bankrupt, well, then you're out. But if the company starts doing well again, they've got to go back and make up for all the dividends they missed. So preferred shares are safer than common shares, but they lack the upside potential. They're not as exciting as common shares.